So, welcome back to this session of your financial management. So, in our previous session, we tried to understand what is the scope of finance, what do you mean by finance, what are the firm's financial activities, and how are they related to firm's other activities. And we also try to understand what is real and financial assets and the different the two different types of real asset, one being tangible real asset, another being intangible real assets. And also we understood other different types of financial assets that an organization would be dealing with. And where does it deal? The primary market, the secondary capital market, and we also understood that even lease is a form of financial asset. Now, moving forward, we also understood what are the difference between equity and borrowed funds, and what are the different kinds of equity funds, one being preferential share funds, second one being equity share funds, what are right shares, what are bonus shares. Then we moved forward with what is meant by borrowed funds, who are creditors, who are lenders, what do you mean by a bond, what is a debenture. Up until this point, we tried to cover in our last session. So let us move forward. Let us now try to understand how is that the financial function of an organization and the management function of an organization is interrelated with the activities, or how is that they are interrelated. Now, it goes without telling that there does exist an inseparable relationship between finance on one hand and production and marketing and other different functions of management on the other hand. That is simply to tell, if you take a weighing scale, on one side of the scale we can put finance, and on the other side of the scale all other activities like production, marketing, promotion, distribution, and all other activities of the marketing could be put on the other side of the weighing scale. And also we know that almost all business activities either directly or indirectly involves the acquisition of fund and also the use of fund. Now to explain this further, we can use a simple example. Now every organization does the function of employee recruitment. It also does the function of promotion of employees. Now, employees will also be there in production department. And now, for the recruitment and promotion of the employees in the production department is clearly a responsibility of the production department. But now, to pay the payment of wages or salaries and other benefits, the production department does require money, and thus the production and thus how the production department involves finance. Or we can take one more example. Now, for a production department, it becomes necessary that it buys new machines or replace the old machine. It can be for the purpose of increasing the productivity, or it can be from the point of view that the existing machinery has become obsolete. Now, this act of buying a new machinery will also involve the flow of fund. Now, we can also take the example of promotion and distribution department. Now, sales promotions or the policies comes with the view or comes as a part of marketing, but it could be advertising or any other kind of sale promotion activities definitely requires outlay of cash, and therefore it is going to affect the financial resources. Now, as I discussed, I mentioned some of the words which meant as outlays of cash or which meant as flow of funds. Now, all these words simply means that you buy, you sell, you get money when you sell, and whatever money you have got, you are going to invest or put it in different other activities of your organization. But I do suggest that whenever you're going to speak of financial management, instead of using the lay terms like expenses, you should use terms of financial management might be like flow of fund, outlay of cash. Instead of telling loans, we'll have to tell borrowed funds. So there are certain terms that being a finance specialist student or a financial manager that you would be using, unless like the rest others. You'll always have to remember, and if there are any confusion regarding all this term, you by yourself will have to clear at the moment that you get the confusion. Otherwise, keeping it for some other future day is definitely becomes a burden on you. And I do remember when on the first day when I asked, why did you take financial management? Most of your answers were representing the fact that all of you would like to get employment under this field. So, definitely to get employment or to be on the top when you get such opportunities, it becomes necessary you speak the language of financial managers. So from that point of view, understanding all these terms become important. Okay, now speaking of this financial and management, there might arise some of the questions like, where is the separation between this production and marketing functions on the one hand, and where is that finance function of marketing, the money available to meet the cost of production and marketing operations on the other hand? You can also have a question, where do the production and marketing function ends and the finance function begins. Now, for now to answer these two different questions or these two basic difference, there are no any clear cut answers. The finance function of raising and using money or fund, although has a very much significant effect on other functions, it need not necessarily limit or stop the general running of a business. That is to tell, yes, finance function is very much important for any other organization. And when we speak of financial management or in terms of a financial manager, we tend to give importance very much for the finance aspect of an organization. But in the practical sense, it need not always happen that a company should always first, give importance for the finance, or it is that the finance, you know, is the first thing that a company has to solve or resolve. There are chances that, and it is definitely in practical sense that all other activities will combine with finance and make an organization. But definitely, it goes without telling that a company which has financial crunch or financial trouble first sees to that it gives more weightage to financial consideration, and if at all the money is remaining, then the other function or other light functions of the organization would be cleared. Or in simply words, that is to tell, here being a financial manager, we give much importance for financial aspects. But when you go out there in the market, every other department shall and will have to combine together and come out with the decisions, or if there are any kind of issue in the organization, they have to solve it together. And also, it goes without telling that a organization which has crunch, or to tell which has less amount of finance in its hands to do other activities, will definitely see that the financial obligations are met first. That is to tell, manufacturing is very much necessary than the advertising. It does not mean that advertising is a less important function, but when you have less amount of money, you produce become important. And if your goods are very good, no matter what, whether you go for advertisement or not, your customer is going to buy your product. But thinking that without your promotion or advertising, your customers are not going to buy, and when you have less amount, investing it on advertising becomes a idiotic decision. Because no matter how much advertising you do, if you do not have a product in your hand to sell it out, what are you going to sell? Ideas? Your advertisement? So, in times of financial difficulties, it becomes necessary you invest your money on what the main functions of the company. And as we speak about companies, those who have less amount of fund in its hand to outlay, there would be also some of the companies which would have huge reservoir of funds, or which would have regular supply of funds. Now those companies would be more flexible in formulating all these production and marketing policies. Now, in fact, the financial policies would be devised in such a way that it would fit production and marketing decision of a firm in practical sense. Now, when we speak about so much about finance, there is something that you'll have to know in detail. Now, we'll have to understand what are the functions of finance. Now, definitely, it goes without telling that it may be or it is difficult to separate the financial functions from might be production function, marketing function, or any other function. But all these functions themselves can be readily identified. Now, the function of raising funds, investing them in assets, and distributing the returns earned from assets to the shareholders are are respectively called as or known as financing decision, investment decision, and dividend decision. Now, this particular thing, what I mentioned, encompasses the entire function of finance of an organization. So how does a financial manager does work is that he usually points down what is the fund that is necessary by an organization. He lists out all those things. Okay, once that is done, he'll see the ways how this fund could be raised. Raising of funds simply means from where these funds could be arranged. Am I going to get it through the way of equity? Will I get it through the way of debt, debenture? Or am I going to get it from a creditor? Or am I going to give a debt? Now, the financial manager, once after listing, decides this. Now, once he decides and once he gets the fund, he will have to invest it in different kinds of assets. Now, investing different kinds of assets simply means is that you have fund, you allocate it. Might be for production department or any other department for which the fund is necessary. Or also investing it in the third assets also become important. That is, you have fund, you invest in some investment of some other company, you get a return. Now, when you invest it on the production, what happens? On the production or marketing, you produce goods or you render service, and by doing so, you will earn the profit. That is the return. Now, the profit that you have definitely has to be distributed for those who have in the first place given money to you. So that decision will also have to be considered. So these three, that is first being financing decision, from where you are going to get the money. Second one is investment decision, that is whatever money that you have, where are you going to invest it? And third being, by investing all those money, the profit that you have earned, how are you going to distribute it? Becomes the third function, telling the dividend decision. Now, when these three are the main, and there is one more function of the finance. Now, when it does these three functions, definitely there is inflow of cash and outflow of cash. But the company will also have to see that when the money comes in, when the money goes off, the liquidation should be maintained compulsory, or the liquidity of funds should be there in the company. That becomes the fourth function, which is called as liquidity decision. Now, liquidity simply means how fast or how quick can you convert your assets in the form of cash, or how much ready cash do you have in your hand, along with all other types of important decisions that an organization takes. Maintaining a liquidity in organization is equally important. So, by discussing so much, we can clearly identify that the finance function include four main things. First one, capital mix or financing decision. Now, financing decision is also called as capital mix because when you're going to speak about arranging the funds for an organization, definitely either it would be a capital borrowing or a debt borrowing, and the mixture of the capital and debt is called as capital mix. That is the first one. And the second one is investment decision. The investment decision is also called as long-term asset mix. Now we tend to call investment decision as long-term asset mix with the fact that yes, I invest, but on what am I going to invest? Machinery? Yes, when you invest money on machinery, is it possible to invest and get the return in a year? Or is it that your investment goes beyond a term of 1 or more years? Definitely, it involves a long time period, and that is why we tend to call it as long-term asset mix. And the third one, as we discussed, it is dividend decision. Now, this dividend decision is also called as profit allocation because dividend is nothing but your profit and you are going to share it. So, the other name that your dividend decision has is profit allocation. And the fourth one is liquidity decision. Here we spoke that how much liquid money a company has. What is the raw money or the raw cash that I have in my hand? And definitely all this decision of having liquidity in hand involves less time. So that is when we tend to tell the liquid decision as short-term asset mix. So these are basically the four different types of decisions: invest, finance, dividend, and liquidity. Okay, now moving forward with the finance decision, that is long-term finance decision, investment decision, financing decision, dividend decision, and short-term finance decision, that is nothing but liquidity decision. If I am not wrong, I mentioned all these things. Yes. Okay. Now moving forward. Now A firm's finance function is one simultaneous and also it is continuous in a normal course of business or in the day-to-day activities of business. They never necessarily occur in sequence. That is to tell, here we mentioned first it is finance, then you invest, that you have dividend, then when doing all these things you see that there is liquidity. But in the practical sense, all these things are simultaneous. That is to tell, it happens together. There is no any sequence that first you will have to do that, second you will have to do this, or third is that. All this would be present and it is present together. Now, this finance function, it has to be done by a person who is very skillful in planning, controlling, and execution of the firm's activity. Now, that where a financial manager's role become important, because unless like a production manager or distribution manager or a marketing manager, they are concerned to what work they do. That a production manager, he'll have to see that he has necessary raw materials for producing, and he sees to that whatever is the aim of the company, if it is 500 units per year or if it is 5000 units per year, he has only the work of producing it. Now the marketing manager, he'll only see to that using different types of instruments and tools that he distributes his products for wherever the demand is there. He increases the demand, he maintains the demand. But when it comes to finance manager, he will necessarily have to have the knowledge of every other department that is there in the organization, because it is his funds or the funds of his department that is going to be invested in every other department. In simple words, it your finance is nothing but, as we discussed earlier, the lifeblood of an organization. Yes, the organization has different working parts, but if the finance itself is not there, what is the use of them? How will they work? So, a finance manager's role plays very much important. The next one is, yes, now long-term financial decision simply means all those decisions which involves longer time horizon. Now, yes, now second one is here I have mentioned performance and value of the firm. That is to mention now the role of financial manager in the eyes of shareholders becomes important from the viewpoint that the shareholders are never interested in the performance. How do you do it? Their main aim is the value of the firm should be increasing. They only tend to see that I have invested with the intention that I earn more, and you will have to return my investment with something more than what I have given. And the next one is there is involvement of higher managers or higher management when it comes to taking of your financial decision. Now the next important decision that we are going to speak about is investment decision. Now when we speak about investment decision, it does involve what is called as capital expenditure. Now, this investing decision is nothing but you invest on the capital or the capital assets of the company. So investment, along with when you invest, it does involves its own expenses. Now those expenses which occurs due to investing is called as capital expenditure. Now, because they are called as capital expenditure, they are also sometimes referred as capital budgeting decision. Now, you definitely know what is budget or budgeting. So, moving forward, now this capital budgeting decision involves the decision of allocation of capital, or in other words, commitment of funds to long-term assets that is going to yield benefits in the future. Now, the two important aspects you'll have to remember under the investment of decision is, first one is that you'll have to evaluate the profitability of the new investment, because when we speak about investment decision, it will have to be such a decision that if you invest, you should be sure that you are going to get a good return, because investment decisions are complex in nature. They involve a long time period, and if at all there is any kind of wrong decisions taken, it might prove very much wrongful for a business organization. There are cases wherein by taking a wrong investment decision, a company might have wound up. The next one is measurement of cut-off rate. Now this cut-off rate simply means you're going to measure it against the prospective return of the new investment. That is to tell, a new investment has its own expenses and it will have its own return. You are going to compare whether the return is more compared to what I am investing, or is there any chance that I am going to lose my investment. And definitely a cutoff rate in which a return is more would be acceptable by a company. And also it goes without telling that the benefits or the future benefits of these investments are difficult to measure and can never be predicted with certainty. That is always there. Now, the risk in investment arises because of this uncertainty. Now, this particular sentence you will have to remember not only in your subject but for all the decisions that you are going to be taking in future as a financial manager. Definitely when you invest you have return, but when you invest there is uncertainty always. You never know what is the result of it. You can predict, you can tell probably, but there is no certainty. And the amount of uncertainty decides the amount of risk that each investment has. So it always becomes necessary that all these investment proposals should be evaluated or analyzed in terms of both expected return and risk. So that you not only tell that this is the expense, this is the return, but along with whenever you speak about return, you'll always have to speak about the risk also. Now, besides the decision of committing the funds into new investment proposal, that is to tell, investment decision, yes, it mainly does the work of investing on things, especially on the new things. Yes, but this capital budgeting, whatever we were speaking of, it also includes what is called as replacement decision. Now, this replacement decision is nothing but the decision of recommitting the funds. Okay, especially the recommitting means or the replacement means, now you might have invested your money somewhere. Okay, now you would have invested with the expectation that it is going to give at least a fair amount of return. But if that is not going to happen, or whenever you are going to realize that the assets are becoming less productive or non-profitable, what you tend to do is you try to take all the money that you have invested from the place which is becoming less productive and you try to reinvest it in somewhere else. And one thing you will have to remember is that whenever we, in our layman's life, we speak about investment, we speak about investing in shares. But whenever in terms of a financial manager, we are telling investment, it simply means you are allocating your funds in different activities of your organization. As I mentioned earlier, could it be production? Could it be marketing? When you allocate fund, it is nothing but you are investing in that activity. That is called as investment. To make it easier, I can give example of Zomato. Now, this Zomato is, as all of us know, is a food supply business. You can order from different restaurants. They provide you with the food. Now, Zomato tried to diversify its activity. It started during the period of lockdown, a new facility wherein they had their own grocery. You could order, they could give you grocery. But this grocery or this activity or this new business is right now is proving to be inefficient for these people. Yes, so when they had come out with the idea of diversification, they have definitely invested in that idea of theirs. Now, because it is proving less efficient, they are trying to take out the money and reinvest it back in some other activity. So this act of replacement decision is also included in investment decision. Okay. Now, we also spoke about cut-off rate. Now, there is an agreement or argument that the correct cut-off rate, or in to put it in very easy terms, your cut-off rate is nothing but a required rate of return. You might have heard this, might be in your bachelor's when you studied your accounts, or in your cost, the required rate of return. It is nothing but an investor simply doesn't invest on something. When he has money, he'll see that what is the rate of return. If I invest so much, what is that I'm getting? And whatever he is getting, if it is in the purview of his required return, only then he would be investing in that. So this cutoff rate is also called as required rate of return. Yes, and that the cutoff rate or the required rate of return when it comes for financial decision is nothing but the opportunity cost of capital. Now, what do you mean by this opportunity cost of capital? Have you heard it somewhere? Definitely you have heard, if not in your bachelor's, at least in your first semester economics. Now the opportunity cost of capital is the expected rate of return that an investor could earn by investing his or her money in the financial assets of equivalent risk. Yes, that is called as opportunity. To tell it in very simple words, you as an individual or you as an investor, you have two options. Either invest in the shares of company A or either invest in the shares of company B. Yes, and you decide to invest it in company A. Okay, you see to that you have required amount of cutoff rate or what is called as required rate of return. And if it matches your expectations, you are going to invest in company A because you have the required rate of return. Now, opportunity cost is nothing but the return you would have earned by investing it in company B. So I hope there is no confusion regarding this required rate of return or your opportunity cost. The next one moving forward is financing decision. Now this financing decision is the second important function to be performed by a financial manager. Now it does not simply mean that it comes second or which comes first. Irrespective of first or second, in the normal course of financial manager, he'll have to take decision of all the different things simultaneously. For a financial manager, from the point of view of taking decision, no activity which involves finance is of less important because it is the money which is being involved in every other decision. Might be 1 rupee or might be crores of rupee. Loss will always be loss to a company and the profit that is being earned will always be profit. No matter what has been mentioned in the books, there are some things which works out very, very differently when it comes to practical things. All that I see is that I as an individual or I as an organization, when I work for it, I see to that I have money. Now, this financial decision takes a very much more time than what is right now we are having in this particular session. So let us stop it or leave it here for this particular point for this day, and let us continue whatever we'll have to discuss in the next session. Now, this financial management is very much interesting subject, and also it is complex in nature. So efforts are definitely necessary from your point also to understand this subject. And I would also like to mention that yes, exams are there, you'll get all the study materials that is necessary, and you are equally brilliant in learning it in a day or two, writing the exam, getting through your results. But that is not what I need. What I need or what I expect from your side is that you understand finance as a subject and you do it by all your heart. So you have any kind of confusion or any kind of clarification you need, no matter how many times you need, you'll always be given help from my side. But I would definitely see to that there is effort from your side. So don't keep it for some other next day. Start understanding the subject right from today. So whatever is necessary for you all to understand this subject and to whatever extent is possible from my side, definitely I would be giving you all. So for this day, here we would end this session. And this week, since you had 4 sessions, the next session would be in the coming week on Monday. So all the other information I would forward in your group. So we would wind it up here and continue in our next session. Wait until I take your attendance and later on you can leave the meeting. Thank you, students. Yes, since I have taken your attendance, you can leave the meeting. All the study materials that we discuss would be posted in your groups. Not either, both in your WhatsApp group and in your classroom. You can leave the meeting for the day. Thank you, students.